Okay, when we look at the private real estate investment, the trickiest thing here becomes the calculation of NOI. So the NOI calculation here becomes one of the most trickier part, and you start with the income, you remove the vacancy and the collection losses, you remove the operating expense to get the net operating income, and using that net operating income you are going to predict the price with the help of cap rate. So that is something that comes into factor. When you extend this idea to the equity part, to the case where you have to find out the per share for an equity REIT, there it becomes a little tricky. Before that, the most important part here becomes the net operating income for the first month, because we use the infinite annuity. So NOI becomes a trickier part, so I'm going to talk a little bit about calculating that NOI. The other part that I'm going to look at is what to do in the publicly traded real estate REITs, and what are the complex part about calculation there. So when I look at a very long formula, and I am looking at one of the questions of the Schweizer, a REIT might have many things. It might have NOI, cash equivalent, account receivable, total debt, other liabilities, the estimated next 12-month NOI, the capitalization rate, and shares outstanding. And you might be asked to calculate the price of per share option. So last 12-month NOI minus non-cash rent plus full year adjustment for acquisition is equal to pro forma NOI for the last 12 months. Expected next 12-month NOI, you can increase that with the given rate. Once you have that, you can estimate the operating value of the real estate. Once you have the operating value of the real estate, then you can add back the cash equivalent, the land hand for development and everything to get the gross asset value, after which you can remove the total debt. After whatever you get, it is for the shareholders value. So even in the REIT you have to start with the same concept, calculate the net operating value. For that you have to get the NOI. To get the NOI you have to do various adjustment. The next 12-month NOI. The other term of contention here becomes the FFO, adjusted FFO, and different kind of FFO that you can use. So funds from operation is accounting net income plus depreciation plus deferred tax minus gain from sale of property or debt restructuring plus loss from sale of property or debt restructuring is equal to funds from operation. So funds from operation reported adjust reported earning in a popular measure to continuing operating income of REIT or REOC, and depreciation asset back under the premise that accounting depreciation often exceeds economic depreciation for real estate. Therefore, tax liability associated and periodic charges are also excluded. The adjusted FFO is an extension of FFO that is intended to be more useful representing current economic value. The AFFO is known as cost available for distribution or funds available for distribution. The calculation of AFFO generally involves beginning with FFO and then subtracting non-cash items. So you start with FFO minus non-cash item minus recurring maintenance type expenditure, leasing commission. So you get the adjusted FFO. Now recurring maintenance type capital expenses and leading commission, I don't know why they should be subtracted when they are recurring, but yes, they are done to get the adjusted FFO. The straight line rent refers to the cash rent paid during the lease, but rather to the average contractual rent. So this is something that is given here. You have another question here to calculate the asset value of REIT. It again starts with the estimated 12 month cash net operating income, fund from operation, cash equivalent, account receivable, other liabilities. You have approached net asset flow, price to FFO, and discounted cash flow, and all these methods. So to calculate the adjusted estimated cash NOI and assumed capitalization rate, you could directly use. So not going to use the FFO, but rather you are going to use the NOI. Don't confuse that with any other term, and then you are going to do that. The value per share using price to FFO valuation is shares outstanding. FFO per share is $7, so funds from operation is 70. The third method is price to adjusted FFO. So funds from operation subtract non-cash, subtract recurring maintenance times share capital expenditure equals AFFO, shares outstanding, AFFO per share, and when you get per share you can multiply it with the multiple to get to the final value. So these are some ways of adjusting this, and I'm talking from the Shwesa.